Hi students. Here are your notes for 2.5, which is going to cover taxes, which I don't think I have to convince any of you that this is a really important section that we're going to cover. All of you will use this at one point in your life. With taxes, I just want to kind of have you buy into knowing how to do them even more. A lot of us rely on TurboTax, which I myself use. Make sure you pay attention to everything that you do in TurboTax, because this year was something new. They had this new way of uploading your W-4, so I could just upload a PDF and it would input all the values for me, so I didn't have to do any of that work. Well, what it did is it left off a very important zero in one of my withholdings, and it was telling me I owed federal government so much more when in fact I was actually due for a refund. So that's why you want to make sure you check your math and check everything. All right, so let's get started on the steps. So there are 5 steps to calculate how much you will owe or maybe even get back from the federal government. So the first step is calculate your gross income. And that means anything you earned for the year. Then you're going to calculate your adjusted gross income, your AGI. And what that means is you're going to take everything you earned for the year and you're going to take away things that you put into that maybe were tax deferred. So we're looking at a pension plan or a retirement or charities, so forth. Calculate taxable income. What that means is whatever you get from your AGI, we are going to go ahead and take away some deductions. And then step 4, we're going to use a good old table with percentages to figure out how much do we owe. And then we're going to compare it for step 5, how much we actually gave the government throughout the year, and see if we're entitled to a refund or do we actually owe the government. Okay, so let's get a little bit more familiar with these terms. So gross income is the sum of any income you receive. So like wages, tips, some of us don't claim those, but we should be claiming them. Earned interest sometimes just from banks, our savings accounts, so forth. Maybe rental income and so forth. So anything that you receive. The adjusted gross income, which we call AGI, is your gross income minus any tax deferred savings contributions. So again, if you're putting money into a 401k, you could take that out and so forth. So what's nice about this is it brings down your income, so then you're not taxed as much. Okay, now your taxable income. Now we're going to look at what can we actually tax. Your taxable income is the amount you will take to the tax tables, which I will always give you, or my open math will give you, to determine the amount of taxes owed before credits and withholdings are applied. So taxable income is the AGI minus either, so not both, just one of them, either the standard deduction for your filing status or your itemized deduction. So what that means is the federal government has come up with some way of some formula that will say, if you're single, your standard deduction is $12,000. But say you're single and you own a home and you have all these expenses and all these things you've done throughout the year. Well, if you actually add every individual thing up, if that's more than $12,000, you want to actually do the itemized. So you want to do whichever is larger. Okay. So interesting fact. Prior to 2018 tax year, you could also claim personal exemptions. Exemptions of $4,050 for each member of the household were subtracted from your AGI along with the standard or itemized, whichever one you chose. Starting in 2018, however, the standard deduction was doubled and personal exemptions were eliminated. So now we don't do personal exemptions. We just figure out, should we do the standard deduction or should we itemize? So when you are filing your taxes, it's dependent on your filing status. And so your filing status is determined by your family situation. So it is possible to fall into more than one category, but you choose the one that's most beneficial for you. So, if you're single, that means you're not married or you're legally separated or divorced, or you could be married and you're filing together, or you're married and you're filing separately, or you're a head of household. Just means maybe you're unmarried, or you paid more than half the cost of keeping up a home for the year, or have a qualifying dependent living with you. So we will go more into this with our examples. Or your last situation is qualifying widow or widower with a dependent child. And so why these scenarios are important is because it shows us, based on your filing status, how much your standard deductions are. Okay, so your filing status determines your standard deduction, which I just said, and tax liability. So let's put this to use. So here's your first example. Polly works as a server. In 2018, she earned $28,450 in wages. Okay, so she earned this much. She also earned $6,200 in tips. And then she also earned $230 in interest from a savings account. Polly also contributed $2,800 to her 401k tax-deferred savings plan. So I'm going to stop reading there, because everything that I underlined is what she earned, right? So that's going to be part of her total income. So I'm going to take $28,450, add it to her tips, add it to her interest. So that is my dog, and I'm not going to start re-recording. I'm very sorry. I'm going to add those up, and I should use dollar signs, get you into good habits. $34,880. So that is everything she earned for the year. But out of her earnings, she tucked away $2,800 to her retirement plan. So, and the tax deferred gives it away. So what that means is she lowered her income so she could be taxed less. So this is why it's smart, because then also when you retire, you have more money. But it's really smart to put a lot into your retirement because it brings down your income. So her adjusted income, another word for that is AGI, is you take everything she earned and take away what she contributed. And again, dollar signs are important. So I end up getting, I'm going to rely on you all knowing how to use a calculator, $32,080. Now I have to figure out what is her deduction. So remember, the deduction is based on her family situation. So Polly is unmarried and lives with 2 children. Now, this is where I mentioned you could fit into more than one category. I mean, humans are not that simple where we just fit into one category. But you choose the one that's going to fit best for you. So she's single, she's unmarried, but she's also head of household because she has 2 children. So which one's larger? It's the $18,000. So I'm going to go ahead and do the $18,000. Okay, now what is Polly's taxable income? Well, I take her AGI and I take away the deduction. And I end up getting $14,080. Okay, I'm going to stop the video here and we'll start a new video.